Good morning, folks. My name's David Dinerman, and I'm a trustee at Hampshire College. This panel notwithstanding the fact that I'm trained as a lawyer, we're going to try to make this a conversation that won't put you to sleep. We're really going to bring this from the perspective of, I'm a trustee, I'm the chair of the investment committee at Hampshire. We developed a very proactive ESG-oriented investment policy in 2011 and have been implementing it since. Keith will bring the perspective of an advisor. He's a lawyer with a firm called Reinhart in the Midwest and has advised institutional investors in this area for a number of years, including one of the largest institutional investors. And Garvin will bring the perspective of an investor. As his bio describes, he decided not to be a and kind of guy to pursue rocks in the desert, but got his MBA and has been an investor with an eye towards sustainable investing. The question I want to start with is, the question that I want to start with is that fiduciary responsibility has evolved a fair amount in the last 15 or 20 years, and some of the events that occurred in and around the Great Recession had some real impact about how people think about modern portfolio theory. Would you folks care to comment on how that's affected how you think about it and how that's being done today?
I'm happy to kick that off. If you want to go to the next slide.
She gave us a clicker.
Oh, she gave us a clicker.
Yeah, we get to advance our own slides.
You're kidding. Boy, this is really high tech. Okay. I learned something already today. This is great.
Good start.
Okay, so what's changed? I think one of the things that's changed basically is lawyers have started actually reading the Uniform Prudent Management of Institutional Funds Act. And a lot of lawyers haven't read the whole thing yet, but the traditional way of looking at it, which most of the advisors that if you are hearing that fiduciary duty is a problem, you're talking to a lawyer who's not read all of what I call UPMIFA. And the things that they really focus on basically have been that the duty of prudence says you're supposed to exercise the same care as what everybody else is doing. So in other words, the inherited structure is what you're supposed to follow. Whatever we've been doing, it's great, just keep doing that. The other thing that they tend to focus on basically is that the duty of loyalty basically just means that you can't directly steal funds, that you have to avoid self-dealing and misconduct. And that's basically the kind of advice that lawyers have been given. But if you look at what the Uniform Act actually says, I just want to point out some things that we're starting to rediscover that are in the Act. One of the things basically is that you could see that the Act actually requires fiduciaries to consider economic conditions and the charitable purposes of the organization and the fund. That's one of the things that I think is the challenge that you're trying to reconnect to now. Diversification is a goal, but it doesn't say that you have to diversify and own everything in the market. It's a risk reduction thing, but too much diversification actually becomes a risk in itself because you're exposed to whatever the market is. Investigating and verifying facts is another fiduciary duty, so that's something that we're rediscovering, and around discussions around climate risk, I think, are in particular really critical to this because there's a lot of basically just personal opinions that are going on. So this is something. This is one of the other things. Fulfilling the mission and balancing both your current needs of your endowment with the future impact that investments and the future world that your beneficiaries, the students, the faculty, the citizens that you're serving are going to be living in, that's like a relevant factor for endowments. So I guess to give the context here, there's the impression that fiduciaries are required to basically maximize short-term gains, and nothing could be further from the truth, basically. The drafting committee of the Prudent Act basically said that you have to tailor your investment program to your charitable purposes. Again, this is something that the lawyers haven't been reading. So you're starting to, I think we're going through a phase where we're starting to kind of reconnect with the fundamentals of what this actually means. And there's some in other jurisdictions, they've been paying a lot more attention to this. I think the US is somewhat behind. The UK government back in December basically just did they had a fairly extensive sort of legal review, which took a couple years, and came out with some advice for their endowments, their charities, basically saying that trying to clarify and get away from the kind of reckless conservative advice that has been given over the last couple of decades by lawyers, and clarifying that you really do not have an obligation to maximize returns. It's basically focusing back on what your mission is. Financial return is probably part of your mission, so you can't ignore that. But they have laid out a process for what they call a total impact approach, which basically involves looking at what is being done with your money, what is in terms of the uses of it, the impact that your investments are having on that particular mission, and what's happening in the supply chain. Basically trying to look at things through a very much more holistic lens in terms of the mission that you have. And I think you've been talking about how central the higher educational industry is to this whole discussion. So to answer David's question, basically we are in currently I think a transition in understanding of fiduciary duty and fiduciary responsibilities. I don't know if any of you were around long enough in the investment industry to remember when it was imprudent to invest in stock.
I remember that.
Yeah. We are going through another transition like that. That transition was the transition to the phase that we currently are dealing with is our inherited structure. But the dot-com and Great Recession disasters basically started to chip away at the investment approaches that had been accepted as being the holy grail, the only way to do things. And between the 20th and 21st century, we've had a lot of not only changes in questioning the assumptions around investment theory, but just the environmental changes. Climate risk is something that was not on the radar when the inherited investment theories were developed. The growth of capitalism and increasing living standards in markets around the world, which are beginning to put more stress on our environmental resources. That was an issue that wasn't much of a problem in the 20th century when our inherited investment approaches were being developed. The current issues that we're dealing with in terms of income disparity, there's a whole host of things here. And at the end of the last transition back in the 90s, when basically we moved from in fiduciary duty, there's a list of things that are prudent and a list of things that weren't prudent, to thinking about investing as a whole on a whole portfolio basis. the restatement of trust basically was amended to say that there are no universally accepted and enduring theories of financial markets that basically last forever. Fiduciary duty has to meet the circumstances and the knowledge base of the times. And I think that we are, and you are, right at the heart of a transition that's going on. I want to close just by leaving the Heron Foundation investment policy up, because I think the Heron Foundation went through a fairly lengthy study and sort of introspective process to try to look at how they could balance both the management of their investment portfolio and their grant portfolio, their mission, so that it would be consistent. And this is basically what they came up with. And you know, one of the things that I think that this kind of tees up for us is basically just 3 different questions. One of them is focusing on the societal and systemic side effects, or the externalities that are being promoted by their investment practices. So they're trying to be intentional about identifying those, identifying the practices that undermine what their goals are, and also look at whether or not their investment practices that could be better aligned with their investment mission. So that's really, I think, the overview of where fiduciary duty is. If anybody tells you that fiduciary duty is a roadblock, they're living in the 20th century.
Well said. I couldn't agree more with everything you say. And David, in terms of framing my answer, I'd also like to start by going back to Dr. Crow's a wonderful keynote this morning. Barbara, congratulations on inviting him to do that. He really set the stage for us. Because his comments very much parallel what we think at Green Alpha Advisors, where I manage portfolios, in terms of economic theory, what we think about, am I going the right way? Let's see.
Yeah,
No, those are your
left.
slides. Left. It's a little counterintuitive.
Yeah. Which is good for us.
Yeah, as is our whole philosophy, right? Inherited versus intentional.
Yes.
And I thought Dr. Crow's comments could not have been more in line with what we're here to talk about at this conference, because do we not perceive a world wherein we can intentionally design an economy that can run in parallel with Earth's underlying ecosystems and its various carrying capacities, such that the human economy and those things can theoretically persist side by side indefinitely, the true definition of a sustainable economy. And to further echo Dr. Crow, I think it's safe to say that an economy like that will not emerge by serendipity. Us left to our own devices, just cruising forward blindly, are not going to arrive at that place. So we need to think about an economy that can theoretically endure indefinitely without overtopping things like the worst effects of climate change and carrying capacity and resource scarcity and everything that everyone in this room knows all too well. And so we thought a lot about an evolution of modern portfolio theory. And rather than managing to fit into a style box or to be beta 1.0 versus a given benchmark, we thought more about, well, what does an indefinitely thriving economy theoretically look like? And then can we start building portfolios of representatives that are working towards that economy, or in some cases already might fit into it? And we started that with a thought imagination experiment. What would an economist 50 years hence, who lives in this theoretically sustainable economy, have to say about where we are in 2015? Would he or she ask what companies that existed then were great and got us to this fantastic sustainable economy that we have now? Which ones had to evolve and which had to go on the discard pile of history? And that was where we started. And as you can tell, it definitely represents at best an evolution of modern portfolio theory. And so in terms of answering the question, David, it's about making the canon evolve. What we assume to be the basis of fiduciary responsibility is MPT, and everything that Markowitz wrote in his book, which, as you correctly point out, in the 50s, came from a time when no one had ever heard of climate change or could imagine resource scarcity. So we thought you need to use the whole world and the best solutions to all of our great systemic risks as your opportunity set, and not a pull-down menu of which companies you want to have from whatever benchmark you're trying to manage to, the S&P 500 or the Russell 2000 or what have you. So if we can get modern portfolio theory to evolve in a way that makes sense for the times we live in, it's good that we're completely on the same page. Then if the canon about which we make all of our assumptions about responsibility come from changes, then so too can evolve our notions of fiduciary responsibility. And on that point, on that note, we make 3 quick points. First, we note, and we talk to trustees and institutions all the time. That looks a little faint, but hopefully y'all can have a look at it. I'd also be happy to send slides to anyone who wants. ERISA, which is the highest standard, it does specifically spell out the diversification as a requirement. However, it doesn't make a requirement for 100% sector exposure, meaning there is room to leave aside the greatest systemic risks that have the potential to crash us into the worst effects of climate change and resource scarcity. In fact, ERISA doesn't specify full index broad market exposure, but rather what it calls prudent diversification, which I would argue could be taken to fit into the new economy just as much as into the 20th century legacy economy that you were just discussing. The second point that we like to make is that pragmatically the standards all talk about using carefully documented transparent methods. Most people apply these standards using an IPS or your outside consultant. But from a pragmatic standpoint, if you look at the broader category, say, for example, of the energy sector, we talk a lot about not being in fossil fuels because they're a cause of one of our greatest systemic risks. There's plenty of ways to get energy exposure without fossil fuels. And ideologically, the fiduciary standard is about something much bigger. They use substantially the same language to describe the requirements of, we all know these, duty, care, prudence, and reasonableness as a way of building trust. And it's true that a 401k or a 50C or an endowment is created to exist in perpetuity. So their time horizon is indefinite. So a true fiduciary, as you were just saying, should be farsighted and acting as much in the spirit of the role as in the pragmatic, Barbara. So I think there's a strong case to be made that fossil fuels are in violation of duty as well as a poor investment choice for the very long-term horizon. And as such, a forward-thinking fiduciary might, in fact, choose to omit them as a part of their duty, as opposed to in spite of their duty, which seems to be the conventional wisdom that we inherited from Markowitz. So my third and final point about fiduciary duty is it's also important to note that nowhere does the phrase maximize investment returns come into play. Rather, it says reasonable care. Obviously, part of being a prudent fiduciary is also about managing risk. Fossil fuels have significantly embedded risk. Beyond denuding our planet of scarce resources, companies in the sector are debt-laden sometimes and always beholden to government subsidies and national and supranational oligopolies to set prices and manage supply. I think we've seen that very much recently. So much for the free market, right? Where is that reasonable or prudent? And to underscore that point, I put this one in here. You guys might, probably most of you know Mark Jacobson's work from Stanford. He and his bright team of economists think this is what the energy mix for civilization looks like over the next 35 years. And the big black wedge that quickly diminishes over the next 20 is oil and gas with nuclear. Now, they don't envision a carbon price as much as we might all want that. Nor do they think that we are at peak oil. They just simply think that renewables and the ability to deploy renewables into things such as electric transportation are going to become so inexpensive that they'll just simply crowd out fossil fuels economically. If these guys are even half right, I think it's clear that we might consider recovering some of the value from our fossil fuel investments while there still is value there to recover. This is a 35 years. So again, for a perpetual horizon investment such as an endowment. The last two I'll show are about portfolios that I manage just to show these things in practice. It's always nice to talk theory, right? But what if you have to work in the trenches and actually produce results? The top line there is NextX. That is the mutual fund that I manage. This is a 2-year history, which is the entire life of the fund. So somewhat short, but it's versus this S&P 500 there. you can see that while being entirely fossil fuels free, but nevertheless well diversified, I have NextX in about 30 sectors, 28 to 30, given the day. It's had no problem competing over just the 2-year period, having very competitive performance with the S&P 500. And then the bottom one there, the one marked PBW, is the Wilder Hill Clean Energy Index based ETF. And that shares our commitment at NextX with remaining entirely fossil fuel free, but is invested entirely in the energy sector. So I think that for its brief 2-year history anyway, this shows two things. One, full diversification does not have to mean fossil fuels. But I think it just as clearly shows that the fiduciary standard of remaining diversified is nevertheless very important. Finally, oops, there's my counterintuitive button again. Finally, this is one from an institution in San Francisco, some of you guys may know, called HIP Investor. They've taken it upon themselves to map how things do versus Markowitz's theory itself. The black line there is the efficient frontier as defined by modern portfolio theory. Like any data set, it may be plotted on a curve, and here it is. You can see the portfolio that I manage with the longest track record is sort of the furthest right green one that sits right on top of the efficient market line there. The Next Economy Index is what we call it, Green Alpha's Next Economy Index. And you can see that over its 5-year history, it does indeed sit above efficient markets itself, meaning the efficient frontier is defined by Markowitz itself, meaning that without having fossil fuels, one may indeed over now what's actually now a 6-year time frame, be very well diversified and have superior risk-adjusted returns compared to the efficient frontier itself. So I think that we have shown that with the emergence of things that Markowitz couldn't have imagined, such as a world wherein energy isn't only defined by fossil fuels, one may still remain very prudent, fully diversified, have competitive returns, and in fact, at least over the last 6-year period, have better risk-adjusted returns than the holy grail of Markowitz, the so-called efficient frontier.
Okay.
Thanks, David.
Thank you both. Last spring, Harvard published a position paper about how to think about this whole area of ESG investing, in which they said, and I'm quoting here, that an endowment is a resource, not a political instrumentality. The position that suggests that taking any kind of consideration of ESG investing would be inconsistent with fiduciary responsibility. Implicit in that is a perspective that there is such a thing as politics-free investing. Would you folks care to comment on that?
Yeah, I think that really tees up the issue pretty nicely. And there are a couple of observations. One is sort of the behavioral bias that's present in that statement, because I think that we have unfortunately evolved into a system where the behavioral preferences and the moral preferences of the agents that are involved in the system are really being placed in a position which is above the mission and the purpose of the organizations that they're managing funds for. Now, it really strikes me as setting up a situation where Harvard is really a hedge fund with an educational institution attached to it, and the educational institution has to adjust its priorities to the moral political preferences of whoever is managing the university hedge fund. It's kind of gotten the cart in front of the horse. But I'm serious. I mean, that's one of the things. The other thing that it doesn't do is basically, I mean, it's responding to an approach to investments that I think does not recognize a lot of the changes in the environmental, social, and economic circumstances that Harvard and all of us are living in. I think the thing that we just talked about basically is that fiduciary duty can't become, it's entirely true that you can't replace your own political or personal moral views, but that's not what we're talking about. We're talking about trying to deal with realities of the challenges that we have and the roles that economic activity play in influencing those challenges.
Here again, I'm entirely in tandem with everything you just said. I think I'll add to that it's more like in the business schools of this world and the finance schools and just whatever is embedded on just even watching the finance channels on cable, that we're more conditioned to want to follow the dictates of the rule book as opposed to rational empiricism, observing the world as it is and responding in kind. And whether or not the rule book that we've all inherited is based on ideology or a very pragmatic view of the world in a different time doesn't really matter, because we don't live in that world anymore. And modern portfolio theory as the canon that we rest on, and subsequently fiduciary responsibility as the outgrowth of that, does indeed need to evolve. And it's exactly through conferences like this that we make it happen.
You know, I find it really interesting. The UK government basically has, in this advice that they issued back in December to British foundations, endowments, and charities, basically, they are developing a tool which I guess is not fully developed yet, but they've announced that they're rolling it out for nonprofits to use in terms of trying to measure the social impact and environmental impact of their investment portfolio and their investment decisions. So, I mean, as you can see, there is really a transition going on around the legal advice that's being given to investors that are starting to recognize some of the externalities, the side effects of the way that we invest our assets.
I want to frame this next sort of scope of conversation around the idea of what I'll call financial sustainability as opposed to environmental sustainability. Keith, you've written an article or two about intergenerational neutrality, as you frame it. That's a concept where it seems implicit and important that fiduciaries look at, and this is particularly true in the context of endowments and foundations, look at a longer view because of the purposes of the institution and how that interplays with fiduciary responsibility. Can you folks comment on that?
Well, this is, I think Dr. Crow kind of hit it right on the head, basically, when he was talking about how difficult it is for most of us to be able to think out more than a few months or a year or something like that. That's the real challenge for fiduciaries. That's one of the main duties that you have if you are managing assets that are intended to provide both current and future benefits in perpetuity in many instances, is to evaluate and develop your investment strategies and your evaluation of the risks that are you're being exposed to and that you're exposing your future beneficiaries to in the context of the future. So it's a central tenet of fiduciary duty, basically balancing current and future responsibilities.
I'll add to that the practical application from an investment manager point of view by mentioning that we attempt to balance those two things by having both a top-down and bottom-up approach that attempts to hit both of those things. From the top down, as I mentioned, we ask what are the causes of the big systemic risks that confront the global civilization. We avoid the causes of those, starting with fossil fuels. Here as an aside, I'll note that when I get asked if we're planning to divest of fossil fuels, I say divest, we never did invest. Because here, again, we view those as a primary cause of systemic risk, and therefore our economic theory couldn't assimilate fossil fuels from the get-go. So avoiding the causes of the big systemic risks, A, but then B, making sure to invest in a sustainable economy analog for every sector that we can find from the legacy economy, find a sustainable economy analog that provides the same function to the global economy or to our society, if you will, but that does it more efficiently and more sustainably. Because if you don't have every sector represented by some sort of sustainable industry or company, in what sense do we have a truly indefinitely sustainable economy? If there is a weak link in a chain, it will break. So we believe in the whole economy becoming sustainable. So at once we avoid the causes of systemic risks and invest in a better alternative, an evolution of an economic function provided by a sector in the legacy systemically risky economy. So that's the top down, and that's very clear. You know, as Dr. Crow said, our lives are short, and sustainability is a big long-term issue, and it's hard for us to assimilate those things, and yet that's our attempt to do that. Okay, so that's the long-term view. That's the 30-year view. If you buy a green alpha portfolio, and then in the short term, we work very hard to find examples of all the companies that fit all those macroeconomic criteria I just explained, and yet that are very solid companies, great balance sheets, great financials, growing their earnings per share and their revenues rapidly, and hopefully trading at a decent value. Here in particular, I'll use an example, one of our favorite holdings, First Solar, right here in Phoenix, Arizona. Here's a company that made $2.55 last year per share, is going to maybe grow to about $4.50 this year, has a ton of cash, virtually no debt, is growing 70% year over year on the top line, and has a huge pipeline of business. And yet, guess what? Today it's trading at about 75% of its tangible book value. I think Graham Dodd methodology would say, buy that thing with both hands. And here I like this example because it's once top-down replacement for a systemically risky coal plant, making power from the sun instead, and yet on the fundamental basis it's fantastic. So I think it's likely to be okay in both the short and long terms. So that's my attempt at a practical application of the problems you guys were discussing.
MIFA has been used in a number of conversations that I've participated in as a shield from thinking about ESG investing as a consideration as a fiduciary. Keith, would you care to comment on that?
Yeah, I would. That's why I call it up MIFA. Really, if you really cut to the chase, basically, I think fiduciary duty has been used as a shield to prevent putting the fiduciaries and trustees and investment managers in a position where they have to talk about and evaluate and think about and think through some very difficult issues. But that's not really what fiduciary duty is about. Fiduciary duty is about framing the issues and making sure that the trustees, the investment program, thinks through how those apply to the goals and the mission of whatever organization the money is serving. So I think it's unfortunate that it's been used as a blocker, but it really is intended to be used as a key to open the door to discussion of fact-based consideration of those issues.
So, Garvin, a natural follow to that is that risk as a consideration as a fiduciary plays into that, and how do you think about that in the context of both being a fiduciary and looking at sustainable investments?
I agree that I think that both modern portfolio theory and as an extension fiduciary responsibility has been used by many folks as a hidey hole to avoid confronting these difficult and challenging issues. And I think that the best response can only be practical application in the real world of an evolution of modern portfolio theory, and just to demonstrate that it works. Nobody's going to buy the argument from the ivory tower. No one ever believes a back test. You have to put dollars in a portfolio and start showing it can be done. On that note, I'll go back to Harvard, not to pick on them too much. Recently, I was in Boston serving on a panel with a professor from there, David Eccles. You might be able to find the panel on sustainablebrands.com. And I asked him, right on the panel, do we perceive an evolution occurring? And he said in response, yeah, because of guys like you. People, we don't sit here in the ivory tower and come up with new theories about how we can make things better. What we do is we see what works in the real world and then develop theories about how come you guys were able to pull that off. And so I think being the tip of the spear is really the only way to do it, because in the absence of empirical demonstration that it's possible, who's going to believe you? Who's going to have any reason to step outside of their comfort zone in terms of portfolio theory or fiduciary responsibility?